Hi, I'm Alex, welcome to the channel and thanks for tuning in. In today's video, we're going to talk about a new exciting SPAC that so far is quite under the radar. It's at a much earlier stage than a lot of the other SPACs we've seen recently where there's been a lot of hype around them. So if you missed out on one of these early, Nikola, Hyliion, Workhorse, DraftKings, Nugget, Virgin Galactic, just to name a few, then you'll definitely want to keep an eye on this one. What's also interesting is that one large institutional investor, who was also an investor in Nikola before it exploded in value, has also invested in this SPAC, so it's definitely one to keep an eye on. If you like videos like this, please smash a like button. It's so helpful in getting the YouTube algorithm to push this video to a wider audience. If you like investing related content, then subscribe to the channel. I know a lot of my recent videos have been on SPACs, so don't worry if SPACs aren't your thing. I've got a load of great videos coming soon on penny stocks, dividend stocks, and great growth stocks. But if you do like SPACs, I've also got a few videos coming soon that you definitely won't want to miss. And as well as that, I also have videos on how you can become a better investor, showing the tips and tricks that professional investors use and that I use in my full-time job where I'm a professional investor, and that will help you too become a better investor. So if you like the sound of that, then subscribe to the channel. As always, I'm not a financial advisor and these videos are purely for entertainment and educational purposes only. But let's get straight into it. So what is the SPAC? Well, this time we're looking at Haymaker Acquisition Corp II. We know this is another SPAC, a special purpose acquisition company, or a cash shell, the process where a company lists on the stock market, selling its units made of both common equity and warrants. The proceeds of this IPO are kept in a trust and ultimately used to make an acquisition of another company. Now in another video, I'm going to go through everything you need to know about SPACs, everything to do with the shares, the warrants, how all that works. So hopefully that'll be interesting if you're trying to decide whether you should invest in the shares or invest in the warrants. Now, this SPAC is at a much earlier stage than many of the other SPACs we've seen recently. For example, Hyliion, Nugget, Nikola, where the acquisition target may have been identified, or indeed the acquisition may have been completed. Each of these news events often results in a surge in price, and I see a lot of investors investing at this point at perhaps a valuation that is pretty high, and where you're unlikely to stand the same chance of making the return as one would if they invested much earlier stage. Now it's really important to say here that investing in an earlier stage SPAC obviously has a greater degree of risk. The way SPACs work is that they have a 2-year period to use that cash to make an acquisition. If no acquisition is completed in that time period, it can be extended on the basis of a shareholder vote. However, it may be delisted and the cash may be returned to shareholders. The risk here is actually, as a shareholder, you get returned a lot less than you paid for the shares in the first place. But again, my other video all about this will cover this in a lot more detail. With Haymaker Acquisition Corp, as I said, it's at a much earlier stage. They've raised the finances, they have the cash in trust. However, now they're in the process of looking for an acquisition target. Will it be another electric vehicle company? Who knows? However, what we do know from the S1, the registration statement, is that this SPAC will be focused on making an investment in the consumer or the consumer services sector. Now, yes, that can be pretty broad, but it gives us a rough idea of what the business may be investing into. So, what do we need to know? Well, in this case, it actually has a very strong management team. Combined, they have over 70 years of experience in the consumer and consumer services sector. And from this, they have great networks and connections to enable them to find one of these acquisition opportunities. In addition to this, they've also successfully completed another SPAC. Haymaker Acquisition Corp I was listed in October 2017, and in March 2019 completed its acquisition. Now this definitely has some issues that we need to consider. It may even bring a positive scenario for this investment, but I'll touch on those in a second. There's the risk that they never find a company to acquire. Now this SPAC has a period of 24 months from the time it's raised to use that cash that's in trust to complete an acquisition. It can be extended on the basis of a shareholder vote. Ultimately, if no deal is done, the cash will be returned to shareholders. If during this period of time of seeking an acquisition, large fees have been run up in an attempt to identify or actually complete a transaction, the actual amount returned to shareholders may be much less than originally invested. So that's a real risk that we really do need to consider. In this example, I think it is somewhat mitigated by the fact that management have done this before. They have a proven track record. They raised a SPAC and they invested it within the 2 years. We'll touch on which company they've acquired under that SPAC and what learnings there may be from that in a second. However, there's two things we need to consider here. Number one is that it is the same management team. However, there's a risk that management time will be split across those two SPACs, and not enough focus will be put on this recently raised one. In addition, the acquisition they made in their first SPAC is not performing well currently, and there's a risk that from an operational perspective, that may take up even more of management's time and resources. Will they have the capacity and the focus to spend on this SPAC to identify an acquisition target and complete it? That is a time-consuming task. So, what is the SPAC that management have done before? Well, in October 2017, they listed Haymaker Acquisition Corp I, and in March of 2019, they completed the acquisition of One World Spa. Now, this is a business providing health and wellness services on board cruise ships and destination travel locations all around the world. Now, we certainly have the benefit of hindsight here to be able to see what's happened to the cruise sector and the global travel sector overall as a result of the health crisis. The business has clearly been hit massively and is struggling. However, that's not the company we're investing into here, so we actually needn't be concerned with that. And in fact, there may even be some positives from this. There'll definitely be some learnings within the management team from this situation with One World SPA. And what we might see is the acquisition made by this SPAC actually be a lot more resilient and defensible. Certainly, I think that's something we have to hope. Next up, we need to think about the sector focus. As mentioned before, they're going to be invested in a consumer-related business. Now, if you've watched any of my other videos, you'll know that this is a sector that I typically don't like. I'm all about super resilient businesses with high growth, and investing in businesses like that has enabled me to develop a really strong track record across economic cycles. I like B2B businesses with strong revenue visibility, providing mission-critical services with strong growth prospects. Typically, I don't like consumer businesses for the alignment to discretionary expenditure, especially when we take a step back and think where we are in the economic cycle, with unemployment increasing and disposable incomes falling. However, in this scenario, perhaps there's actually a timing impact. Now hear me out. The SPAC will have 24 months to make its investment. So either, in that period of time, we can either assume the economy may have recovered from where it is now, and so in fact it would be a good time to be investing in a consumer business as disposable incomes are increasing. Or alternatively, you believe that the recovery will take a lot longer, in which case the argument would be that you're able to acquire a consumer company at a lower valuation than you would be versus a market where it's performing extremely well, and disposable incomes and therefore demand are rising. So is that an interesting timing play there? Next up, I think it's important to think about who the other investors are here. Now here, I need to credit Reddit user Benzions, who actually shared a screenshot of his Bloomberg terminal. And here we can see that KPOS Capital, a large institutional investor, is invested in this SPAC. What's worth noting is they were also an investor in Nikola before the share price went crazy. Now you can't read too much into that, but it's just worth noting. In addition, there's loads of other really reputable institutional investors already invested into this SPAC, so that can give you confidence. However, as I have pointed out in previous videos, you can't just rely on these names for your diligence. Even the best professionals make mistakes. One of my favourite examples of this is the Bessemer Venture Partners anti-portfolio. I put the link in the description, you should definitely check it out. What they do is they talk about the main investments they've rejected and the reasons for that. And if you look through that list, basically every single one is a well-recognised global tech firm today. It's a really amusing read. But what we learn from that here is that you can't just blindly copy professionals. Everyone makes mistakes sometimes. What I also like here is that the advisors, both Cantor and Stifel, are both involved in this as well from a capital perspective. They're acquiring some of the shares in the IPO, which is a sign of their belief in the business itself. That's not always the case with SPACs, so that also gives me a little bit more confidence. They've had the benefit of speaking with management, understanding the strategy, way more than we can as retail investors ascertain at this point in time. So, what am I doing? Well, for me, this does actually sit firmly outside what I typically like investing into, especially where we are in the economic cycle. I like having a portfolio that enables me to sleep easily at night, not worry about the impact of a recession or a pandemic on my portfolio. However, I do see a really exciting angle here. This is certainly a speculative play, and as we've seen recently, many SPACs have received a lot of hype and have grown in share price when actually the fundamentals of the business oftentimes don't support that valuation. In this scenario, there's not yet been that hype. I think there is a strong management team who I think have been through a difficult experience with their first SPAC, but they're proven they can do it, and I think they'll have learnings from that experience that they'll bring into the company that they acquire in this SPAC. I do think the timing here is very favourable that mentioned before. Either you're banking on the economy having recovered, or if you believe the recovery will take longer, you'll be able to acquire at a lower valuation than you would be in a market where it's performing very well. So ultimately, acknowledging this is a speculative play, I've made a very small investment in this company, less than 0.25% of my overall portfolio, to watch how this plays out over the mid to long term. So thank you so much for watching. Please let me know your comments in the comment section below. I really love hearing what everyone has to say, what everyone's thoughts are, and getting involved in the debate. There's always some really interesting opinions. If you like the video, please smash the like button, subscribe to the channel for more similar content, but thanks for watching and I'll see you in another video.